Welcome back. You're watching Traders Corner, and at the desk, as usual, for our weekly look at the charts is Garth McKenzie, the editor and founder of Traders Corner. Garth, thanks for joining us.
Thanks. Hi, Bronwyn.
So we've had US President Donald Trump give the markets maybe a little bit of relief with some of the commentary around the trade wars and pushing out that deadline to implement those Chinese tariffs. So if we take a look at the chart of the S&P 500 and maybe put the fundamentals aside, what is it telling you?
Yes. Let's have a look at the S&P 500 and then also in the context of what you're saying about the trade war. And I think to some extent, Trump has continually guided us with his tweets, as he does all the time, via his Twitter account, that things with the Chinese are going well and trade talks are proceeding successfully and so on. So one could probably make the argument that a lot of good news might already be priced in, and the devil's in the detail when eventually we actually do get this trade war resolved, or some sort of an agreement between the US and the Chinese. And one does wonder whether the markets are now primed for all the good news, and if we don't see a buy the rumor, sell the fact kind of scenario. And I don't know. We'll have to see what comes out of this. But I do know that he's certainly continued to feed the market positive information. Now, if we look at the S&P 500, this is the weekly chart over here. I'll look at this quickly, and then we'll look at the daily chart. The weekly chart, as you can see, it broke down quite violently in the latter part of last year, and it's been seeing a very, very powerful rally off those lows that we saw in December. We've had a number of weeks consecutively up, but we're starting to get into an interesting zone of resistance here at about 2,800, and that becomes more clear if you look at the daily chart of the S&P 500. Here is the daily chart that looks back over the last 6 months of trade. And what you can see is this zone of resistance at 2,800 is created by all those prior tops that we saw in October, November, and December last year. And the market is now pushing up into that region at the moment. Yesterday's candle was interesting. It was a bearish reversal candle on the session. Now we can't get too excited about that, but I do think it's just interesting that it has occurred at this zone of around 2,800, where we do have a fair amount of overhead resistance here. And I'm wondering if we do start to see a little bit of consolidation here, whether it doesn't maybe retrace a little bit and start to possibly form the right shoulder of what would essentially be a big inverted head and shoulders pattern there. I mean, I don't know. Let's not get too presumptuous about that for now, but it's a possibility if the market does start to falter at this sort of area right now. What's interesting to look at is this chart. This is something that I constructed on Excel using the 50-day moving average and the price of the S&P 500. And what it does is it looks at the price of the S&P 500 relative to the 50-day moving average of that index, and it plots it as a percentage. Now, it goes back about 4 years. And the reason it's interesting to look at it right now is because notice that in the past 4 years, the market hasn't really rallied more than 6% above its 50-day moving average. And approximately at that point in time is when you start to see some sort of mean reversion, where the price of the index and the 50-day moving average start to come together again. Now, that can happen in one of two ways. Either the market can go sideways and the 50-day moving average can gradually catch up to the price action, or alternatively, you could see a pullback in the market. But in any case, whichever way you slice or dice that, what it invariably tells you is that when we're at this sort of stretch level, like we are at the moment, where currently the S&P 500 is almost 6% above its 50-day moving average, historically, you've usually seen some sort of a pullback or some sort of a consolidation or some sort of a mean reversion towards the 50-day moving average from that level. So if we go back to that chart of the S&P 500 and just look at it where it is currently, again, I make the point about this resistance zone at 2,800. It is very overbought. You can see your RSI right up at the upper levels over here. We did get that reversal candle yesterday. So to me, putting all of that together does suggest there's a possibility that we start to see some consolidation here and possibly a pullback. The blue line on this chart is the 50-day moving average that I was referring to, and you can see how far above the price action is currently above that 50-day moving average. So to expect those two to converge is not an unrealistic expectation. As I showed you on that prior chart, it's quite common for some sort of a mean reversion to occur from these current stretch levels now.
Okay, so we're going to have to see how that plays out and whether we do see that reversal start happening. And we're going to have to watch Twitter to see what Trump makes of all of this and how we go forward. But let's come back home because we're still seeing the top 40, the spot index, which we started looking at last week, kind of pushing into that area of resistance that you identified last week.
Yes, it is. Here's our top 40 spot, and we're going back here about a year and a half to look at the trading action. The reason I go back that far is really to bring in all those prior lows that we saw through 2018. And that was quite a big zone of support last year, between 49,000 and 50,000 on the top 40 index. You can see how all the lows, kind of came together in that sort of area. Yeah. Now, we've had a big rally off the lows recently, but the market is now pushing up into that area of resistance. And it's had a strong rally, so one would expect that at some point soon we should probably see some level of consolidation beginning to occur here. What's also interesting to note is if you put your Fibonacci retracements on here, what's happened is the market has basically done a 61.8% Fibonacci retracement of that entire sell-off that we saw from September into October of last year. And the market's gradually rebounded, and it's, as you can see quite clearly there, the area around about 50,000 or just above 50,000 is where your 61.8% retracement comes in. So that is quite feasibly an area where we would expect to see some sort of consolidation and possibly a little bit of a pullback in the market at this sort of area. What I want to do is also just zoom in on that zone that I've created a box around there now and just look at it on a slightly shorter term time frame. So here we're going back about 5 months or so. And there you can see again how the market pushed up to the 61.8% retracement yesterday. And we had what's referred to there as a bearish hammer candle pattern that formed. That is essentially where the market at some point during the day was up quite a lot, but it was unable to sustain those higher levels, and it pulled all the way back down and closed near the session's low. And what it meant was that you end up with a candle pattern like that, which has a long tail to the upside and sort of a head. So the name kind of hammer, because it looks a bit like a hammer. And often what we find is those types of reversal patterns can indicate a short-term top in the market. Not always, but very often in my experience, especially when you've had a situation where the markets run very, very hard and you get a reversal candle like that, it can indicate a short-term top, and then you see some pulling back thereafter. Now, if we take a look at the same kind of chart here as we did for the S&P 500, we look at the top 40 index relative to its 50-day moving average. Again, we're looking back over 4 years here. And similarly to the S&P 500, you'll notice how in the past, when the top 40 gets to around about 6% above its 50-day moving average, that is usually around about the time when you find some sort of consolidation begins to set in and some sort of mean reversion where the price action and the 50-day moving average start to come back together again. Yep. Now, we're at that point. We're around about 5% above the 50-day moving average currently for the top 40 index. So as you can see in the past, that's generally around about the time when one would expect some sort of a consolidation. So if we look back at this chart once again of our top 40 spot index, there you can see the 50-day moving average. That's that red line that I'm pointing out on the chart there now. And notice how far away the price action currently is from that 50-day moving average. So given everything I've said here, given the fact that it's pretty overbought, it's rallied up into that 50,000 area where there's a lot of resistance. It's the 61.8% Fibonacci retracement. We've had that bearish hammer reversal, etc. One would expect that this is a logical area where one might start to see a mean reversion, where the price and the 50-day moving average start to come towards each other, and that can happen again in one of two ways. Either the price goes sideways and the 50-day moving average will catch up, or alternatively, the price might come back a little bit, or you may get a combination of the two. But what I'm saying is that to me, it seems sensible that given all of the stuff I've just spoken about, it's possible that we see some sort of consolidation and a bit of a stalling of the current market rally that we've seen lately.
And given all of that, you're actually going to put some money on it and initiate a trade for this week.
I am. I'm taking a small trade on the ALMI future. Now, what I've got here is a chart of the top 40 future. The ALMI is effectively a mini contract. Every point on the ALMI future represents 1 rand. So we're currently trading at around about close to 50,000 points on the futures. So R1 per point means that every one ALMI future is giving you exposure to approximately 50,000 rands worth of market capitalization. Now, based on what I've spoken about already, the fact that the market ran up into resistance, and you can see there's some resistance up there. We did get that reversal candle on the top 40 future yesterday. There's also some negative divergence on the RSI on this top 40 future. So based on all of that, I've decided to go short a very small position on the ALMI futures. I've done 2 contracts, and we've gone short at a level of 49,687. My stop loss is going to be above yesterday's high, which is above 50,200. So that means we're risking approximately 1,000 rand here, and there and thereabouts. So it's a very small percentage. It's not even 1% of our capital that we've got in our South African portfolio. If I'm right here, then I'd be looking for a move down initially to 49,000, but quite possibly to 48,500, and we'll monitor it as it goes from there. But that's the trade that we've put on for the show for this week.
It does seem quite conservative. Why are you going, with risking so little? Maybe walk us through the rationale behind that.
Yeah, you're right. It's a very small risk. I mean, less than 1% of our portfolio is what we're risking here. The reason for that is this trade is against the prevailing trend. You can see the market generally is still trending upwards, and there is still a risk that we could see a squeeze to the upside. It's possible that I may be too early on this short and that it might push a bit higher first before it comes down. I don't know. So based on all of that, I think it's prudent to just take a slightly smaller position and rather play it safe from that perspective. Perhaps I could add to the trade if I see that it's working and it starts to move lower. But I didn't want to be too aggressive on this trade, given that it is a trade that's against the trend, and inherently that does add extra danger to a trade.
Okay, we'll have to see how it pans out, but let's take a look at the portfolios and how they're doing.
Yeah, so here's our South African portfolio. These are all the trades we've done so far this year. So we've had 2 losses and 1 winner, and now this week we're in that short position on the ALMI future that we've just discussed. We are slightly underwater for the year to date, minus 0.73%, but it's still early days. And then on our offshore portfolio, we haven't been particularly active. We've got a put option on General Motors, which is not working for us at the moment. We're slightly in the red there, so about 1% down on the international portfolio as things stand at the moment.
Let's hope that ALMI trade pans out for us. We'll have to check in next week. But you have some courses coming up as well, or one course coming up. If viewers want to get in touch with you for more detail, how do they do that? Yeah,
I've been around the country lately, and my last course in this current series is in Durban on the 9th of March. Anyone that would like to attend this, it's a high probability trading course, a full day on a Saturday. Email me, garth@traderscorner.co.za, and I'll send you all the information.
And if anyone hasn't yet, how do they subscribe to the free weekly newsletter?
Yeah, if you go to traderscorner.co.za, go to the middle of the page, and you'll see there's a link there for a free weekly email. Click on that, enter your details, it won't take long, and what we'll do is then send you an email every Tuesday detailing exactly what's coming up on this show for the week.
Garth, thanks so much for your time today.
Thank you.
Garth McKenzie is editor and founder of Traders Corner.